I have some bad news and some good news for you. The bad news is that the game of investing is rigged. Most financial institutions, advisors, and other experts are out there to legally steal your invested money. That is why most investors automatically lose the lion's share of their future returns without even being aware of it. For a typical family, this amounts to over $1 million over the long run. So if you're playing the investing game by their rules, you are toast.
Some pretty strong words from our special guest today, author, entrepreneur, and award-winning speaker, Rowley. His new book, The $1 Million Decision, looks at why he believes the financial services system is largely rigged against everyday investors. I've explored the same topic in my own books, but the question is, does it mean that everyone's better off becoming a do-it-yourselfer? Well, we'll talk about that and much, much more. It's time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies in new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional-style investing to your portfolio. Hi, everyone, and welcome to The Income Generation. I'm David Scranton. Now, you might be wondering, gee, Dave, why are you, a financial advisor in your own right, sitting down today to talk with a man whose new book claims to give you the power to fire your financial advisor? Well, the truth is that I agree that you should fire your financial advisor if he isn't the right advisor for you. And I've said this many, many times before on the show. I also agree that a lot of advisors in our industry are part of a rigged system, often without even realizing it. I'm talking about a system rigged in favor of Wall Street and against the average investor saving for retirement. We'll talk today about how it's rigged, why it's rigged, and what you can do about it with our special guest, Rowley, author of the new bestseller, The $1 Million Decision. Get out of the rigged game of investing and add $1 million to your net worth. And as always, we'll also get some fresh perspectives today from our Financial Advisors Roundtable. But first, let's examine some cold, hard truths you should know when looking for financial guidance. Basically, there are two major reasons that many financial advisors and brokers end up becoming part of this rigged system, or as I sometimes call it, part of the club. Those reasons can be interconnected, and they have to do with the way most advisors are trained and with their business models in which they work. The best way to illustrate this connection is to point out that I myself was, yes, once part of this rigged system, part of this thing I call the club. And in my case, like most, it wasn't intentional. It was simply that at that time, I was still a follower, not a leader. I had a business model built mainly around putting clients in the stock market and keeping them there. In fact, to a large extent, that's what I was trained to do, and it's certainly what I was encouraged to do by managers, colleagues, industry publications, the media, just about everyone from whom I'd gotten information. 30 years later, the only thing about that scenario that's different is me. You see, unlike most advisors, I soon saw the club for what it was and was able to get out. I started doing my own research and listening to the needs and goals of my clients rather than focusing excessively on the biased teachings of my own industry. Why are the teachings biased? The answer is that, in a way, it needs to be for the system to work. In fact, it would be difficult for the system to function in any other way. Bias is a necessary byproduct of the way Wall Street and corporate America work. But unfortunately, that bias spreads like cancer through every related industry, including financial services. Please remember that, as I've explained before, a Wall Street CEO's first fiduciary responsibility is to his shareholders, not to you, not to his investors, customers, or account holders. His main duty is to maximize shareholder value. In other words, maximizing income to his company. And one of his primary ways of doing this is by keeping you invested in the markets as much as he possibly can. In fact, if he doesn't, revenues and commissions and fees go down, and shareholder value decreases. Obviously, people are more apt to stay invested if they believe the markets are strong and going to go up. In other words, when investors are optimistic. So the question becomes, could it be that Wall Street CEOs feel a pressing responsibility to paint a rosy picture and to speak optimistically about the markets more often than not? That decision is for you to make. Now, that might be okay if the financial media cover the markets objectively, but unfortunately, it often doesn't. In fact, in most instances, they're simply parroting that rosy outlook by the CEO. Why? Well, could it be that it's because the CEO's firm is one of their major advertisers that drives revenue for that particular type of media? You decide. And even that might be okay if most investors conducted their own independent research. But many don't want to make the effort. And many advisors work for firms where they're strongly urged to use in-house research sources or specific third-party sources. But the question becomes, is that research objective? Or could it be that those third-party sources are often owned wholly or in part by Wall Street brokerage firms? Again, you decide. Hopefully that gives you an idea what I mean when I say Wall Street's cancer is a bias that spreads like cancer. It spreads vertically through an organization and then horizontally through other sources such as the media. You see, and it isn't really a malicious thing, it's just the way the system works. It creates this optimist club that really has little to do with the needs or concerns of everyday investors. It only has to do with Wall Street's sense of self-preservation. The good news is that I'm not the only advisor who's turned in the resignation card from the club. There are others. You just have to be informed and diligent in order to find them. Robert Rowley grew up in a poor backwater village in a small country, yet managed to become a successful entrepreneur. But then, sadly, he lost most of his money because he trusted certain so-called financial gurus that inspired him to invest 7 years doing his own research about what goes on behind the scenes in the financial services industry. The result is his new book, The $1 Million Decision: Get Out of the Rigged Game of Investing and Add $1 million to Your Net Worth. Robert, welcome to the show.
Hi, David. It's a great honor to be here.
$1 million to the net worth, that's a big number, so I'm looking forward to our interview today. Tell me, briefly, why you believe the investment game is rigged for most average investors, most members of the income generation, as we refer to our viewers.
Yeah, the investing game is rigged because all the big Wall Street firms and a lot of financial gurus and so-called experts are basically very motivated to sell very bad financial products, financial products where they profit the most. So most people end up with these bad financial products where they think that their money is working for them, but in reality, it's only working for the financial industry.
It's funny, I just mentioned just a minute ago that the fiduciary responsibility of a Wall Street CEO is first to his shareholders and not to his customers or investors. So that means obviously that if there's two products or investments he could recommend, one that's really good for his company and just okay for investors, or one that's really good for investors and just okay for his company, he must recommend the former, not the latter, or he violates his fiduciary responsibility. So
right.
We're very much on the same page, but can you share the story of how you first learned about this system and when it first dawned on you that it really was rigged?
Yeah, so when I started in business, I started in my student years totally from zero. And in 5 years, after 5 years of hard work, I became an overnight success. So I made a lot of money. This was, 2005 was the first year where I made a six-figure income, and it was like dreams coming true for me. But I didn't want to spend all that money. I'm not a person who would spend a lot. So I knew that I need to save, I need to invest. So I started to invest that money. But because I was an entrepreneur, I didn't have a clue about investing. I didn't have a clue about money management. So I trusted who? Yeah, you are probably right, financial experts. And year after year, I gave them my money. So after several years of doing that, me and my wife, we said to ourselves, okay, let's take a look at what is going on with our money. So we ordered all the account statements. And when they arrived in the envelopes, I went, are there some zeros missing? But unfortunately, zeros were not missing. We lost most of our money. And that was the start of the darkest period of our lives. I almost lost my sanity. I almost lost my wife at the time, and I almost lost my motivation to work. So it was a really dark time for me. And I was very lucky then that Brian Tracy, who was my biggest mentor and one of our speakers at the events that we organize, we were hosting him for the third time. And after the seminar, we went to dinner. And I told him all about my problems. And then he said something that totally changed my life. He said, Robert, it doesn't matter how much you earn. All that matters is if you have the skills to manage your money and to invest it. And at that moment, I realized I don't have these skills. So I made perhaps the most important decision of my life, and that was I will become one of the most financially literate people in this world. So that began my journey in the financial sector.
Great words of wisdom from a mentor for whom you and I both have a lot of respect. Brian Tracy's always been one of my heroes. So how did you go about doing that? I mean, how much work did it take to learn, to really become an expert? I mean, was it like another full-time job almost? Tell us about the process, the journey you went through to try to become more knowledgeable.
So the first thing I did was to attend all the seminars, mostly in London. So I attended a lot of seminars, a lot of courses, and I read a lot of books. I also did a lot of research online, and I talked with a lot of insiders from the industry. So that gave me, let's say, behind the scenes look to the industry. And I started to realize that this industry is really rigged and that the average person who wants to invest his savings or her savings is basically doomed from the start.
Okay. And, in the 30 seconds we have left, tell us, what are some of the major things that you see that cause this problem, the reasons it's rigged, in 30 seconds or less before we take commercial break?
Yeah, it's very simple. Like we already talked about, the reward systems in the financial industry are basically rewarding financial, let's say, CEOs and advisors who are recommending bad products. And also there is
so it's the core. So it's the core of how they're wired, I believe, is what you're saying, the system. So listen, I'm sorry to cut you off. We need to take a commercial break. We'll be right back with more about your philosophies from Robert Rolih. Stick with us. We'll be right back. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation, again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. I've talked many times about how many advisors end up with business models that make them part of this rigged system, but the problem really starts before that, in the schools and institutions where advisors actually learn their trade. Too often as advisors, we're taught to put our clients into a box, to put them into perhaps a handful of preset categories. In other words, to generalize. We're taught that it's a good business practice to apply certain rules and formulas, rules of thumb, if you will, to every case, rather oftentimes than to consider each case specifically and to work with clients individually. Now, yes, it may be easier to do things that way, but I know from experience that it isn't good business practice, and it certainly isn't what's best for our clients. Here's a great example. Advisors used to be taught this formula. 100 minus your age equals the percentage, or I should say the maximum percentage of your assets that you should have in stocks. In other words, under this formula, if you're 30 years old, the most you should have in the stock market is 70%. If you're 70 years old, the most you should have in the stock market is 30%. Now, over the years, that rule has changed a bit. Today, the formula is often considered to be the rule of 110 or the rule of 120, where you subtract your age from one of those higher numbers. And that's supposedly because life expectancies have increased. But the question becomes, is that really the reason that this rule has changed? Or is it perhaps just to justify having a higher allocation in risky Wall Street products? You decide. Either way, any advisor or individual who would blindly follow the rule is simply participating in this rigged system. They're putting Wall Street's need for self-preservation ahead of their own or their clients' financial goals and interests, whether they realize it or not. Rules and formulas that don't take into account an individual's goals as well as current market conditions or about 100 other important factors are just more examples of this club bias, the bias of Wall Street rhetoric. So why then are investors taught such rules in the first place? Well, these schools are supposed to be independent and unbiased. In theory, hey, after all, they're supposed to be educating us. Well, could it be that a lot of these schools and institutions that in which we're taught that they receive financial contributions from Wall Street? Again, you can make that decision. But no matter how you slice it, the cancer tends to spread far and wide, and that's just the way the system works. And the best way to avoid getting burned by it is to be aware of it. And with that in mind, I'd like to welcome back to our show today's guest, Robert Rolih. In a recent blog post, it's funny, you shared some quotes from your book that sounded similar to things that I've said in the past. And I'd like to go through a few of those and have you elaborate on them if you don't mind.
Yeah.
The first one, which I agree with completely, is the most popular investing products can be the worst ones for investors. Why is that, and which products are you referring to?
Maybe the best example is mutual funds, because mutual funds have very high commissions and fees, and they are basically the most profitable thing for the financial institutions to sell. So that is why most people end up owning mutual funds.
Okay, perfect. Now you also said when investing, greed could be your worst enemy. Again, you're not going to get any argument from me, but tell our income generation members in your own words why you believe that to be true.
There are a lot of advertisements and a lot of ads online offering you get-rich-quick schemes and millions trading Forex and stocks and penny stocks and stuff like this. But most of the time, only the professionals are making money in the short-term trading space. So if you are just an average guy and if you don't want to spend 5 years learning about that, you have no chance of succeeding at getting great returns in the short run. Only the professionals can do that. And like I said, it's a long, long way to become a professional. And even if you spend a lot of time and energy learning these things, it's still, very small, very little chance of succeeding.
In New York City, it's funny because Wall Street and Madison Avenue don't really intersect. But I guess what you're saying is when it comes to investing, Wall Street and Madison Avenue can intersect, and that's a bad thing. And you also said, love risk when making money, hate risk when investing money. Explain.
Yeah. That's the foundation of my financial success formula that I talk about in the book. And this formula says that there are two parts, there are two sets of skills that you need to have if you want to win the financial game of life. The first is money-making skills, and the second set of skills are investing skills. So you need to have both. But the problem is that most people are too aggressive when it comes to investing, and they start to gamble with their money and are not aggressive enough when they are making money. They are not learning enough money-making skills. They are not learning enough business skills. They don't take enough calculated risks in the money-making area, So that is why I say love risk when making money, because there you need to take some risks if you want to increase your income, but hate risk when you are investing money, because there you need to be very careful and cautious not to make any huge mistakes with your money and not to go into the crazy gambling financial products and so on.
Now it's interesting, this next thing, you're kind of sort of a man after my own heart here, because in my own book, Return on Principle, I said there's seven core values to help protect your money in good times and bad. And one of those values is detail orientation, the importance of that. And You also say that knowing the right detail gets you a great return. Ignore them and you crash and burn. And that's not a neat statement just because it rhymes. It's also a neat statement because it's accurate, is it not?
Yeah, that was the reason why I lost a lot of money, most of my money in the past when I was investing it, because I didn't know these details. And if you are not financially literate, if you don't know these things, then you are just, a sitting duck and you are gone quickly financially.
Yeah, it's, well, the devil is in the details. We all know that. And you also said that you have 30 to 50 times better chance of creating a successful business than is succeeding as a short-term trader. Tell us about that.
So I did a simple calculation, and I went out and I researched how many people are really succeeding at short-term trading. And my number that I came up was less than 1%. So less than 1%. Less than 1% of people who go into the short-term trading succeed. And if you take a look at the business, how many business owners succeed. Let's say they have profitable business in 5 or 10 years from when they started. The figure is much, much, much higher. So that is why I say don't go into the short-term trading. You will lose your money. If you have too much time, start to learn business skills and start your own business or something. But don't go into the short-term trading. It's a loss. You will lose your money. You will lose your time.
So in 45 seconds or less, please tell us, what do you believe is the right investing philosophy? What strategy did you develop that you find that works and you think might be transferable to our income generation viewers?
So the foundation of my philosophy just to pick the low cost, low commission investing products, where you keep most of the future returns and not the financial industry. So if I just mention one thing, that would be it. So low cost investing product where you keep the commissions and fees to a minimum. That's it.
Sure, and that's where the devil has to be in the details. If you're willing to do your own hard work and research and roll up your sleeves, you invest in individual securities where you don't have any fees. If not, you have index funds, ETFs, and things like that. So, Robert, thanks so much for coming on the show. We really appreciate it. It's been great having you. And coming up in just a bit, I'm going to talk more about knowing the right time to retire with fellow financial advisors at my Financial Advisors Roundtable. Before that, Miranda is going to break down some of today's most important financial headlines. So stay tuned. You're watching The Income Generation. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation.
Welcome back to The Income Generation. I'm Miranda Kahn. Now let's take a look at some of the big finance stories that moved the markets this week. Federal Reserve Chair Janet Yellen says that the central bank expects to keep raising interest rates at a gradual pace.
That expectation is based on our view that the federal funds rate remains somewhat below its neutral level. That is, the level of the federal funds rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel.
Yellen also highlighted the low unemployment rate, noting it's fallen 1/4 point since the beginning of the year. A new study shows that U.S., German, and British drivers are spending billions searching for parking spots and paying a lot more than they need in order to avoid tickets. That's according to data from the traffic aggregator INRIX. President Trump's pick to lead the Federal Deposit Insurance Corporation withdraws his name from consideration. James Klinger cited family issues as the reason why he asked his name be removed. Apple will establish its first data center in China. It's part of the company's effort to speed up services for local users while also complying with laws that require global companies to store information within the country. And the Royal Bank of Scotland agrees to pay a $5.5 billion settlement. The deal with the U.S. Federal Housing Finance Agency resolves claims over mortgage-backed securities issued prior to the financial crisis. And for much more on these stories, please visit newsmax.com/finance. Now back to David Scranton with more on the income generation.
Thanks, Miranda. Now that you're all up to date, let's hear from our Financial Advisors Roundtable to get our Roundtable's insights on today's topics. Yes, it is time for another Financial Advisor Roundtable. Joining us here in the studio is Jeffrey Small, President of Arbor Financial Services in Melbourne, Florida. Jeff, welcome to the show.
David, it's great to be here.
You know, normally these Financial Advisor Roundtables, as you know, you've been on this several times a show. There's 2 or there's 3 advisors. And today I want to have you here alone because when I listen to our guest today, Mr. Rolih, and I hear him talk, it's almost like I'm listening to you, without the accent, of course. But philosophically, you've told me lots of the same things. In fact, to a point where you're halfway through writing a book right now, are you not?
I really am, and I'm writing a book that really relates to what's wrong with our industry and how it is rigged. So it's somewhat synonymous with your last guest.
Yeah, it's about turning financial planning right side up, I believe is going to be your title, correct?
That's correct. It'll be available in the late fall for pre-sale in October on Amazon.
That's great. So tell us, you know, when you listen to my interview with him, what were some of the things that he talked about that caused some of these problems with income generation members in terms of caused them to make some of the mistakes and so on and so forth? In other words, what are some of the most tangible takeaways that you think they need to know?
Well, he was spot on, but the reality is what we see empirically is that most folks are leaving between $300,000 to $500,000 on the table in as little as 10 or 15 years.
And how's that? I mean, 300,000 to 500,000, 10 to 15 years. He said $1 million. You say 3 to 500, but only 10 to 15 years. You're probably talking the same number. But how do you see that breaking down?
Well, it breaks down a couple of different ways, but the biggest ways is in fees. And fees really are, you know, they're hidden from the average investor, and most folks have no idea what's going on with fees in their portfolio and how it affects their money long term.
The fees are that big of an impact, huh?
They really are. You know, the average mutual fund charges 1.5%, and that ends up being a huge parasitic effect over time.
Yeah. Now, you also talk, it's funny in the book, you talk about, you know, traditional notions of financial planning are morally bankrupt.
Well, that's a very important issue, and it's a very bold...
It's a very bold statement.
It's a very bold statement.
It doesn't surprise me coming from you, but that's a bold statement.
Well, what we've discovered, Dave, over my 33 years in this business is that financial planning is bankrupt morally because it never looks at costs. It doesn't instruct a consumer how to look at costs. Banks don't use financial planning, large corporations don't, and neither does the small mom and pop hardware store down the street. They don't use financial planning to run their books. So why do we? Because it's been forced upon us. It's a cultural distortion that's used to brainwash to benefit institutions. Very similar to what your last guest had said.
But you know, it's not all about reducing expenses, because there's some expenses that are good for the investor, that bring value to the investor, maybe return or give them some sense of protection. There's other expenses that are more frivolous. How would you break down those expenses between, let's say, the good versus the not so good?
Well, you know, it really depends upon what market cycle we're in. And so when we look at expenses, there's a couple different ways investors lose money. One, of course, is in the fee. Another one is if the market drops. And so investors, by our very nature, are not taught how to calculate their net rate of return. And so the Goldilocks zone for an investor is to net 5%. But I've yet to meet one client, even the smartest engineers from NASA, on how they can calculate their net rate of return long term by factoring in their fees and market gyrations either upwards or backwards.
Well, again, this goes to this concept of being not detail-oriented enough. And again, even the smartest NASA engineers, as good as they are at math, don't understand the whole concept of net return to be calculated really the mathematically correct way.
It is mathematically correct, and we really refer to that process as financial engineering, not financial planning. Financial planning focuses on the micro, financial engineering focuses on the macro, and that's really the missing ingredient for investors today, especially your viewership from the sound income generation.
Give us another example of something that you think people miss by not being detail-oriented enough, that perhaps they don't calculate, they don't understand. that they really need to?
Well, that's a good question, Dave. And the reality is most folks aren't getting what they want for their money. They don't know how to get what they want for their money. So they have to work with somebody like us who's a fiduciary that's going to educate them on what their costs are and how to get a decent net rate of return based on what their objectives are. But more importantly, how to create income and keep their asset values intact. That's one thing financial planning doesn't teach folks to do.
It definitely will teach them the income concept. So listen, in less than a minute or so we have left in this segment, can you give us the overview about this financial engineering concept and how it's different and it's more macro than what you're looking at traditionally with financial planning?
Well, financial engineering really looks at the entire situation and makes their money work in concert by measuring the efficiency of their money supply. In other words, how do we get the most output out of their total resources over the course of their lives or a time tunnel of 10 or 15 years or less? And so by measuring various factors of cost, we can engineer how much they can actually improve their output. And that is always between $300,000 to $500,000 and sometimes more. Now remember, Dave, when we lose $300,000, we just didn't lose that in 10 years. We lose that for infinity. And that compounding effect keeps going on and on and on.
Financial engineering, great concept, great name. We need to take a quick commercial break. Stay with us. You're here in studio. You didn't come all the way down from Melbourne to run back, so I know you stay with us. And you also are Income Generation members. Stay with us. We'll be right back with more words of wisdom from my good friend, Jeff Small. If you're not using someone who's well trained in fixed income and you're born before 1966, it may just be time for you to break up with that advisor and move on. I would suggest someone who will care for you through these important years of your life. If you need help finding someone, call or write us. I'd also like to remind you of the special report entitled The Income Generation. This is available free to you, our loyal viewers, online. If you haven't downloaded your report, pick it up after the show. If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Welcome back to The Income Generation. I'm David Scranton, your host, and here with me today in studio is my good friend, Jeff Small. Now, what you don't know is during the break, we were just having a pretty interesting conversation here about a concept that Jeff calls modernization of your money. Jeff, tell our Income Generation viewers just a little bit about what you mean by modernization.
Well, you know, modernization really deals with the fact that you have to position your assets, your savings, your retirement dollars to reflect the current state of the markets. And the reality is most financial advisors, 99% of the industry, does not do that. They over-promote risk, and they think that risk is an acceptable component of your money, and it really isn't.
They over-promote risk. So are you saying that risk is okay at certain times, and maybe the reason you're calling it modernization is because the market's at a record high right now, and maybe, you know, risk on trade is more dangerous now than ever before? Or are you talking more in general?
Well, I'm talking because the market's at a current peak. And empirically, Dave, what we found in 2004 and 2010 is most folks had lost so much money, they were not going to live long enough to recover their asset base because the markets both had 50% corrections in those time frames. So we want to make sure that we avoid risk. And by removing risk from the macro in financial engineering, we can increase the rate of return substantially. Zero becomes your hero.
Zero becomes your hero. I've heard that before. That's great. And it also rhymes. We have two poets. We had Mr. Rolih was a poet. You're a poet. It's amazing. It's the Poet Week here on the Income Generation show. You know, one of the sections of your book is called The Art of Financial Defense, which is kind of sort of what you're talking about. You care to elaborate that on that just a little bit?
Well, the art of financial self-defense really relates to the fact that how do we create the most amount of income from our assets without consuming them? And, you know, financial planning industry, the entire culture, the banks and brokerages, they think it's okay to cannibalize your resources and consume your principal when it really isn't. So the art of financial self-defense is how do we create income while keeping everything intact? We want to eat the eggs, but not the chicken.
There you go. And the other thing you talk about too is the importance of income generation in this new age of quantitative easing. Now, but wait a minute, we're not doing quantitative easing anymore. We stopped doing quantitative easing 2.5 years ago. So why are we still in the age of quantitative easing?
Well, because we're again in a brand new territory, Dave. From a modernizing perspective, the Fed is unrolling their assets that they've bought. They're unrolling $1 trillion, and we've never been there. We're not sure how it's going to impact the markets.
In fact, it's interesting, just this past week, you know, you heard Janet Yellen's comments. In fact, you just heard them again on the show, that part of what they're trying to do is they're actually looking to start that unraveling process right now. You know, we've talked before offline many times about the concerns about the flat yield curve concept, that if short-term interest rates keep getting pushed upward and upward and upward, but the markets don't let long-term rates climb, then you end up with this thing called a flat yield curve, which is terrible for the economy. So I think they're finally starting to figure that out with their comments just this week, are they not?
They really are. She's really taking a dovish approach, the Fed is now, and they actually emboldened the markets to actually increase in value because she stated that she wanted to increase rates on a slower basis.
Mm-hmm. But this concept of possibly starting to unravel the balance sheet and actually take some of the bonds that they've purchased and now sell them back out to the public is anything it's considered slightly more hawkish. And that could, with any luck, push up long-term interest rates. But see, now they really have to, this battle between, gee, do we successfully push up long-term interest rates so we can raise short-term rates more? You know, which is great for investors seeking income. But the problem with that, though, is do they stall the economy by doing that?
Well, the economy's already sort of flat, so it's not really in a growth mode right now. But we are seeing earnings come about for the first time since 2011, which could keep the market growing higher. And if she doesn't raise rates, she just gives the green light to increase the market values even more. And, you know, we haven't had markets this high, but 3 times in 147 years. So really, how much higher can the market get?
That brings you to another topic you have in your book, why you should get out of the market. Now, getting out of the market is a pretty bold and radical statement. Tell our viewers about why you say that.
Well, for the income generation, it's really about getting the best net rate of return that you can. If you can net 5% over the course of your retirement, you're going to be in much better shape long term. The market really averages 5% as a net after cost and market experience with losses long term. If we can produce 5, we can consume 5% of the portfolio value. And that can make a huge difference to a quality retirement.
What's interesting, though, is most people don't realize they can get 5% without the market. They don't realize it, but they can. And that's the beauty of it. So we need to take another commercial break. And of course, I know, again, you came all the way down here from Melbourne, so I know you're not rushing back right away. More importantly, it's important that you, our Income Generation members, stay with us. We'll be right back with more words of wisdom from Jeff Small. Stay with us. We'll be right back. Welcome back to Income Generation. Let's just jump right back into it with Jeff and how he breaks people from the rigged game. Now, it's interesting because right before the break, we were talking about this 5% concept. And I was sitting with a financial advisor recently, just this past week in his office, and I had somebody whose goal was actually to just keep up with inflation. And inflation, of course, has been less than 5%. But he had a tough time believing that he can make 5% without taking all the risk of the stock market. Why do you think that is today, that people don't realize that you can get that kind of return without the market?
Well, I think because basically the financial industry has suppressed that information, as they've suppressed lots of information. But there are ways in uncorrelated, non-volatile assets, components that we can buy for our clients for them to earn 5% and net even more than that.
And the reality of it is that some of it might be intentional, you're right, but let's say it's not as sinister as that. You know, you're a fixed income specialist, I'm a fixed income specialist. What do most advisors know how to get 5% in fixed income?
They really don't, unless you're have a very large amount of resources, portfolio, $3 million or more. you're going to have a hard time finding a brokerage to work with you in that regard because they don't make any money. So you have to remember that the brokerage industry has a house always wins mentality. So if you have a portfolio of $1 million, they're not going to show you how to net 5% outside of buying mutual funds or stocks.
So, for income generation viewers then, if your advisors are telling you, well, don't go to bonds and bond-like instruments, don't go to fixed income, you can only make 2 or 3%, it's not worth it. It's not necessarily because they're trying to mislead, it's because they just, unless it's their specialty, they just don't know how to do it.
Well, they don't know how to do it, David. They're not educated in that regard. And think about it, it takes 1 week to become a stockbroker. And so now you can go out and give people financial advice that's efficient?
Of course not, of course not. And, as you said with the firms, the reality of it is, as our guest said, Mr. Rolih, the reality is that with our firms, they get their research from their firms. And what that means is that ultimately, they're not being taught how to get 4, 5, 6% from income. So they think the best you could do is 2, and that's what their firms want them to think, is it not?
That's exactly what they want them to think. It's almost a brainwashing, so to speak, and the advisors don't know the difference.
Yeah, they don't. You're absolutely correct. We have one more return of my good friend Jeff Small. Stay with us. We'll be right back with more words of wisdom. Welcome back to the show, and I hope you join me in welcoming back our special guest today, Mr. Jeff Small from Arbor Financial Group in Melbourne, Florida.
It's great to be here, Dave.
Jeff, the biggest trouble that I think people have sometimes is trying to figure out if they don't want to do what our guest did today, Mr. Rolih, and they don't want to study for 4 or 5 years about how to invest their own money, then the biggest question is, how do I find the right financial advisors? So many out there, they all seem to have a good story. How do I tell who's right for me?
Well, the best thing your viewership can do, David, is to really work with a fiduciary, someone that has a financial responsibility to put your needs ahead of their own. That's very important. And someone who's going to educate you on the various options you have, but more importantly is going to disclose to you what the costs are so you can measure those costs and make an informed decision as opposed to a gut decision. The problem is most customers, most investors will make a decision from their gut and not an informed decision from their mind.
So the basic part is, yes, somebody who's a fiduciary, because a lot of advisors are more brokers, they're more salespeople, they're more commission-based. They don't have to put your best interest first, but a fiduciary, an investment advisor, has to put your best interest first. So that's good. The patience to educate, I like that. Educating the consumer. You do that, I do that, that's important. Most advisors don't have the patience to do that. And lastly, the disclosure of fees. But how about with risk tolerance? How about determining if it's the right person for me? Because some people are younger, even though the market's at a record high, they might be okay being in the stock market. Others, members of the income generation, are starting to get to a point where they're saying, maybe not so much. How do you determine that?
Well, I think you let the math determine that, David, and so you let them pick. So a 30% loss on earning 5% as an average for 10 years is going to drop the actual net rate of return with a 1% fee to about 1.5%. So does somebody actually want to earn 1.5% over 10 years while the market might go up 8%?
No, sir.
No, not at all.
No, sir. So that's the first thing. So are you saying that everybody then that whether you have 30% in the market or not, it's the same thing? That's what it sounds like you're saying, pretty much.
I think so, but I think they have to really gauge how much risk is potentially in the market with their advisor and say, is the risk worth the reward?
Oh, great advice, Jeff. Thanks for being with us today. I really, really appreciate it.
Awesome, Dave. Thank you for having me.
Okay, I'd like to also thank all of our guests for joining us today in another episode of The Income Generation. I'd like to thank you, our new and returning viewers. And to close, I'd like to paraphrase a passage from my own recent book, Return on Principle. It summarizes a lot of what we talked about on today's show. There is a financial system in this country that we all take for granted that's working for each of us. The only problem is it's not. The reality is that a lot of very smart people, including Wall Street insiders, analysts, pundits, and even, yes, some advisors, are often misleading you. It's not intentional, it's not malicious, it's simply that they're followers, not leaders. And if you don't think you can count on them to become leaders, to resign from the club and put your interests ahead of Wall Street, you might want to look for leadership somewhere else. Thanks for watching. We'll see you next week.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. Learn the truth about Wall Street, the financial media, and the secrets they try to hide from everyday investors. This isn't just another book about investing. Working Americans who have lived through 2 major stock market crashes and the worst financial crisis since the Great Depression in the past 16 years don't need another book about investing. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Stop planning for retirement with your fingers crossed. Read Return on Principle, 7 core values to help protect your money in good times and bad. Available now.